Before we begin our discussion on Buffett indicator, let us first talk about the established truths about the stock markets. Number one, market returns are never guaranteed. Number two, no one can really predict the stock market tops and bottoms. Number three, then what is in our hands? We can only do deep research like fundamental analysis plus technical analysis. This hybrid approach gives us an edge in the market. Number four, but even then, risk management cannot be ignored. Number five, follow the market. Markets will never follow us. Trend is your friend. Hello everyone. Welcome to my channel DK Global Market Insights, where we break down investing basics for beginners. Today, we are diving into the Buffett indicator, a simple tool that legendary investor Warren Buffett calls one of the best ways to check if the stock market is too expensive, fairly priced, or a bargain. If you have ever wondered why the market keeps rising even when the experts warn of bubbles, this video is for you. We will cover what it is, how it works, its history, and the real world example from past crashes. Plus, we will discuss why it might not be perfect in today's world of global companies, AI, and tech giants. By the end, you will know how to use Buffett indicator smarter, including tips on the market cycles and elections. Let us get started. What is the Buffett indicator and when was it developed? The Buffett indicator, also known as market cap to GDP ratio, measures the total value of all US stocks compared to size of the US economy. It's like checking if the stocks are priced reasonably relative to what the country is producing. Warren Buffett introduced this idea in a 2001 article in Fortune magazine. He said it is probably the best single measure of where valuations stand at any given point of time. Back then, after the dot-com bubble burst in year 2000, he used it to explain why markets can get irrational. It is not a fancy formula, just a straightforward ratio that's easy for beginners to understand. But remember, Buffett warns it is a rough guide, not a crystal ball. How is the Buffett indicator calculated? Calculating the indicator is super simple. The numerator is total market capitalization of all US stocks. That's the price per share times the number of shares for every public company added up. We often use the Wilshire 5000 index as proxy for this. Denominator is US gross domestic product, that is GDP, which is the total value of goods and services produced in the country each year. The moment you have these two data, divide market cap by GDP, multiply by 100, and you get a percentage. For example, if the stocks are worth 50 trillion and the GDP is 25 trillion, it's 200%. Right now in 2025, it's around 212%, super high. No fancy tools needed. You can find updated numbers online from the sites like Guru Focus and other several portals. Historical values and bear markets. Now let us look at the history to see how this indicator has signaled trouble. Bear markets are when the stocks drops 20% or more from the recent peak, often leading to recessions. But remember, recessions not always come after a bear market. In year 2000, during the dot-com bubble, the indicator peaked at around 140 to 150% before the market crashed, wiping out trillions. You remember that. In 2008, ahead of the global financial crisis, it was around at 100 to 110% at the market peak in late 2007, then plunged as a housing bubble burst. In 2020, just before the COVID crash, it hit around 150 to 160% level in February, signaling overvaluation right before pandemic hit. And in 2022, it soared to a record 194% in late 2021, warning of a trouble before inflation and rate hikes caused a 25% drop in S&P 500. Did you notice the pattern? High readings above 100% often precede corrections, but the market can stay overvalued for months and years before dropping. Rules of thumb for market valuation. Buffett doesn't give any exact numbers, but experts use these guidelines. If the indicator is below 75%, the market is undervalued. A great time to buy. Between 75 to 100%, it is fairly valued, meaning the stocks are reasonably priced. Above 100%, it is considered overvalued, and above 150% to 200%, like now, it is extremely stressed, raising crash risks. For instance, some say 87 to 111% is modestly overvalued, up to 136% fair, and higher than 136% is overvalued. Then what is the key? Use it as a warning light, not a strict rule. Is it still relevant? Global revenues, buybacks, intangibles, and AI. Here is where it gets interesting, and why some say the indicator needs updating. US companies like Nvidia, Google, Meta, Microsoft get around 40 to 50% revenues from overseas, up from 30% in 2000. But GDP is only domestic, so the ratio looks inflated. Stock buybacks are another issue. Companies spend around $1 trillion yearly repurchasing shares post 2020, reducing supply in the market and boosting the prices without growing the economy. Then there is a major shift to intangible assets like softwares and data, which GDP doesn't measure well. The US is now 80% service-driven economy and less capital intensive. No big factories today, just cloud and applications. Post 2020, AI revolution amplified. AI could add trillions to earnings, but it is not fully captured by GDP yet. So is 212% really a bubble or just a sign of changing world? In short, yes, it is relevant as a starting point, but adjust for these important discussions that we have just now. Maybe compare to global GDP instead. Assessing valuation in changing world. Market cycles, technicals, and elections. So what we should do? Don't rely on Buffett indicator on a standalone basis. Combine it with other tools like price to earning multiple or Schiller P for better accuracy. Track market cycles. Stocks go through booms and busts every 4 to 7 years time. Use technical analysis. Look at the charts for trends, support levels, and distribution patterns, most importantly, where big investors sell quietly before crashes. And one more thing, watch elections. In midterm years like 2026, markets might get volatile from Q2 onward to Q1 2027 due to uncertainty. Stocks often dip mid-year but recover after the results. Historically, midterm year are the weakest in the presidential cycle, but the third year of the term, which is upcoming, is usually the strongest, averaging double-digit gains as policies stabilize, growth kicks in. For S&P 500 spot distribution pattern, diversify, have patience, and focus on long-term charts. To sum up, the Buffett indicator is a great beginner tool, but evolve with the times. Use it wisely, watch cycles, and invest smartly. Now let us transition to some charts. I'll show you exactly how distribution phases appeared so you can spot them yourself. I am now presenting a case study of the bear market in year 2000, which is known as dot-com bubble. Always remember that price is a leading indicator. If you can analyze the market with respect to the price, combining with the momentum indicator like RSI, you can find out the distribution pattern in the market. For example, if you look at the year, market peaked over here in March 2000. Then it was failing continuously for several months to go past the high it has made in the month of March 2000. What it was making? It was making double top kind of market structure. But it is not yet confirmed whether it is a double top or some kind of consolidation in the market, and the finally market will continue its trend on upside, giving a breakout of a bullish flag pattern. But we could have already marked the double top formation. The lowest point is this, what we call it as an apex, that is a reverse apex, and it was at 1313. Market made a top of, it made 1552.87. As I said initially, nobody can exit the market at the top or catch the market at the bottom. So we could have marked on the price chart this apex portion which was coming at 13 and 39. The moment any candle closed below that, it tried to close over here, but ultimately it formed the bullish pin bar kind of candlestick pattern. But finally, what has happened? It here closed below this apex line. It was the first confirmation that probably the market is getting weaker and there is a distribution pattern which is showing a sign of breakdown, which means smart money is quietly coming out of the market. Now, what has happened after that? There is a follow through of the low of this breakdown candle. There was a minor pullback. It generated a hope in the minds of retail investor, but finally again market got rejected from the neckline of this double top kind of pattern, and there was a massive downtrending move in the market. So during this bear market had fallen from the peak to something around 50%, but we could not have exited at the top. But still, if we could have identified the distribution pattern, we could have saved somewhere around 42% further drawdown which has taken place in the market. Now I'll tell you one more thing where it is not only the price action, but we need to have some kind of confluence. Here the market was making higher highs. Look at the momentum indicator RSI. It was making lower highs kind of market structure. Although there was a pullback here, there was a pullback here, but momentum was waning. What does it mean? Market was lacking the momentum, and finally what has happened? There was a breakdown of this low of RSI over here, and it was coinciding with the breakdown of double top pattern as well. Another signal was very important on the monthly chart. Earlier when market was trending up, it was taking support at EMA 21. Usually whenever correction takes place, market takes support on EMA 21, what we call it as a mean reversion or a correction in the market. Then what has happened? As this was the distribution pattern, market corrected, made a low of 768.63 in October 2002, and then it consolidated typical accumulation band and double bottom formation, gave a breakout. The moment any candle closed above 955 level, it indicated a reversal pattern breakout, and then market trend change. The market became bullish. So market has its own cycle. It moves from distribution pattern to markdown phase, then accumulation phase, and then a breakout, and then a final takeaway. Number one, Buffett indicator may be used as a warning sign. Number two, we should always look at the Shiller PE for valuation along with Buffett indicator. Number three, Price is a leading indicator. When used in conjunction with a momentum indicator like RSI, can help us identify distribution pattern before market actually crashes. Task for you. Now you should analyze 2008 bear market and 2022 bear market to find out the distribution pattern and offer your comments below in this video. Keep learning with this channel as learning never stops with D K Sinha.